Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is February 5th, 2018. Kind of getting through a flute right now, so I'm just going to go through this one kind of quickly, despite the fact that we had major moves here in a lot of different markets. Most notably, the S&P 500 for us, as far as movement, with the ETF being SPY or SPY. It's kind of a mixed trend here, but the technical rating, I just want to harp on this a little bit because it's pretty blatant with what's taking place here. So the easiest thing to do is come to the website, you come down to charts, and then watch lists, and then what you'll see is the watch list is our technical review of the market. And what we have are 18 of these watch lists, WL for watch lists, 18 of these observations and kind of reviews of what the market is doing. And when you look at everything that's been taking place with all the different markets, the one that really stands out, which is a major short focus, is the S&P 500. Now this is updated as of Friday, Friday's close, and that with that major sell-off we had on Friday, and obviously the continuation today is no big surprise. So this evening, when we update this information, you'll see that it's still going to be negative, and it does take a couple of hours to run these numbers, so it's not going to be available for the deep dive. But it is something that was still a short focus coming into today, obviously in part because of what happened on Friday. So I want to show the market itself. Here is the S&P 500, and it's down through here. You can see the value chart indicator. These are daily bars, and we actually had the closing value at a point where the market was at minus 15 and beyond. Right now it's at minus 10, but minus 15 really tells you the market wants to, well, not wants to, but shows that the market had moved to such an extreme. I often use the analogy that it's like a rubber band that has just been stretched to its limits, and it's going to probably snap back. And when you get a minus 15, no ifs, ands, or buts, you're going to get some form of a snapback. Now, it's not necessarily saying that we're seeing a bottom, but it's certainly a good indication that you might want to start nibbling if you're a short-term trader to take advantage of some of these conditions. So as it stands right now, even doing this a little bit later today, that we're definitely starting to see some movement here, but we'll see as whether or not these things actually do hold here. So long story short, the extreme sell-off that we had here, when we take a look at the market, specifically in the S&P 500, I just want to show you the tendencies of the market, if I can find it here. Here it is, market tendencies. This is updated as of today, and you can see the S&P 500 gets into this extreme oversold territory. We're at extreme. So we just simply cut it off at extreme, and we're in this particular point 2.5% of the time. So it's not that frequent, especially when we get into cases like we had today. In fact, so much so that I'm going to show you another chart that will, I think, make this point. This is for the S&P 500. This has not been updated for today, but you'll see that when we have this meter chart, just look at the bottom section here with these gray squares. In February, over the last 14 years, we have not had a single day, just a day, not a month or a week, but a single day in February that was greater than 4.6%, and we were down more than 5% in the S&P futures. And so this was quite the extreme, something we don't normally see. I showed this graphic to individuals that are learning to trade the futures and learning to look for markets that they might want to incorporate into their portfolio, and I often will show this so that it gives people perspective as to what could happen if they're going to be trading a market. So in the first 6 months of the year, you'll see that the market can have historically bad days of 4% and 3%, even in certain cases 5% down days. But it gets even worse the last 6 months of the year, at least the last 5 months of the year, where we're talking about in the sevens, if not greater. So bottom line is that I just thought it was interesting that we actually had a new low percent drop off in the market that we haven't seen for quite some time. So this sell-off that with this elastic level being as low as it was, that is dramatic. If ever they're not using that word in a way in which we shouldn't. As far as the targets, this is going to be updated here shortly. But I wanted to specifically leave this for today. There was a gap that if we had broken, and obviously did, below this level, that there was a real potential for the market to really start to rally to the downside. So this is what we call a support gap, something that I really want to ingrain. Usually in the morning on my Twitter feed, I will point out those markets that have support gaps and some resistance gaps, but something that you might want to take a look at it, because there is a dramatic one that if the market were to sell off, obviously it did, that it would cut through this like I use the example of a hot knife through butter, and there's nothing to really hold it. Then we had some other support levels where it did bounce around, but even broke down below the 3 ATR number that we normally look at. So 3 ATR's movement in the S&P 500 plus, I don't know what the official number was, but is greater than 3%, and that's pretty dramatic. So as things stand right now, the systems are long the Russell, where we got long, unfortunately, during the course of the day, where we've got a little bit of a loss going on here. But the great thing about the future side, at least a diversified portfolio, is that our systems on the Dow Jones were actually short. So even though we lost some money here in the Russell on the long side, which is hopefully going to start recovering some of its losses here, we are still able to offset that with some nice gains on the short side in the Dow Jones. If we take a look at the portfolio as a whole, you can see that the Russell was one of them. It is the largest loser we have, but a lot of the other markets certainly make up for that when it comes to the performance for the overall portfolio. We have obviously a nice open position in cattle, but it was the energy markets across all three of those markets that we did quite well on. So kind of a mixed bag trading wise. Was still a profitable day despite the sell-off and the position that occurred here in the Russell, but as I said, we were able to offset it with some of the gains on that particular side in the Dow Jones. So where do we go from here? What I would be saying is this: if we come back to the market, if we do not hold here, and there's every reason to believe that the market could still gyrate around here for a little bit, the fact that we're such a dramatic sell-off doesn't necessarily mean that the market's going to and has to snap back. In fact, it'll probably go through a little bit of a period here. But if we are not able to hold the levels we have right now, we have a support level at 2594. 2600 is the round number, but the official number from our side is 2594. If that doesn't hold, then our next level would be the support level of 2561. And I can't say that this support level here is all that strong. 13 is a little bit better, but it's still not all that significant. The major ones would be right through here. We've got three of them: this one, and this one, and those numbers will pop up later on. But we're looking at 2484. We're looking at 2407. And this is the more dramatic one, which would be 2420. So it'll give you some ideas to where the market could go if we're not able to hold here. But we're definitely going to be in oversold territory here for quite some time as we start to base and then hopefully start to rally again and get back into bull mode. But for right now, we are flat the S&P 500 and obviously hedged between the Russell and the Dow Jones. So that'll take care of it for today. Hopefully I'll feel a little bit better tomorrow and we'll go into a little more detail. Thanks for watching. Appreciate it.